It's the 12 days before Christmas. We'll talk about what that means on today's edition of 3 Minutes on Markets and Money. On September 27th, we wrote an article entitled "The Big Short Squeeze is Coming," and that was really right here at the bottom of the market where we started talking about extra negative sentiment, of course, offside positioning by investors. And that was what we needed here for a decent rally in the markets. Of course, that's what we've seen since then. We got our MACD buy signal in place. It all kind of played out very nicely. But last week, we really started talking about starting to take profits out of this market because we were concerned about, first of all, the extent of the rally, which had gotten very overbought. And also, we were very close to triggering that MACD sell signal, which, again, the buy signal gave us a very good entry point, the sell signal giving us a good opportunity to take profits and reduce some risk. Now here we are. We had laid out the case that the first couple of weeks of December tend to be fairly sloppy trade, and that's because of mutual fund rebalancing and distributions. The last 2 weeks of December tend to be the Santa Claus rally, and what we needed here was a bit of sloppy action that would hold support, not have a big breakdown, and that would set up the rally potentially for year end. That's kind of where we are right now as we start kind of looking at what the market has been doing here lately, holding support, remaining within this trading range. We have worked off some of that more extreme overbought condition. We're still on that sell signal though, and that suggests that upside prices may be a little bit limited here. But again, nonetheless, we do have some catalyst here for some upside between now and year end. Some of that's going to be tomorrow's read of CPI. If that number comes in much weaker than expected, that could be a catalyst boost for stock prices. Wednesday, the FOMC meeting. A little bit more hawkish commentary from them might be a weight on asset prices, but we'll see how that works out. Friday is a $3.2 trillion options expiration day. That potentially sets up market volatility kind of all over the place. Could be positive or negative. So this week could be very volatile. No real tell about where the market's going to wind up. Importantly, we need to hold this support level at the 100-day moving average. A break below that on too hot of inflation or more hawkish Fed or options expiration, that could lead to more downside, potentially back to this 50-day moving average. But as we get past this week, we get into very light trading. Everybody goes on vacation, and that last week of December potentially becomes the best opportunity for that Santa Claus rally. We may not wind up any higher than where we were just previously here. That 200-day moving average may be the target for this Santa rally, but we do have a lot of money flows coming in to wrap up the end of the year, window dressing, etc. So again, use the opportunity where the market is right now. Any little pop over the next day or so, rebalance risk, get ready for that kind of year end, and we'll trade the markets from here as we kind of see getting into the beginning of 2023. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.